Let's have a session on payables days. So this is a type of efficiency ratio. So payables days essentially shows how long in days it takes to pay back the creditors, and those creditors are likely to be your suppliers. Now the formula for payables days is as follows. So payables divided by cost of sales times by not 100 times by 365, because you are measuring in days. The answer is in days. It's payable days, so it's times by 365. We'll take the top bit of that formula. So payables, sometimes referred to as creditors, that's a current liability, so you might find that information on the statement of financial position. Now the bottom half is cost of sales, of course that's your direct costs of producing the good or service, and you'd find that up the top at your income statement, just under your revenue or your turnover. So that's the formula. Payables days divided by cost of sales times by 365. Now, things to remember about payables days. So ideally, you want your payables days to be bigger than your receivables days, because you want to essentially be receiving your debtors, receiving the money in before you're paying your creditors. You're paying the money out. You want the money to come in first before it's going out. Therefore, you want your payables days to be bigger than your receivables days. That suggests that you've got good liquidity and good cash flow. But it's important to not take the mick. You don't want your payables days to be too high. If they're too high, that could be damaging to your supplier relationship. And you particularly want to consider about your supplier and who is your supplier. Are they a strategic supplier to your business? And they are perhaps not replaceable. They're very, very important to your business. So in that case, you clearly don't want to make your payables days too high. And that's particularly the case if they're strategic to your business. Perhaps you use them for just in time, and just in time helps you or enables you to be lean within your business and to be efficient. So therefore, you might want to consider that. Another thing to think about is if you notice that your payables days are particularly high or getting higher, perhaps they're trending higher, and in the same time period you're seeing your current ratio, so your liquidity is worsening, well, that together suggests there's a liquidity issue, there's perhaps a problem in the business, and it might be once you've established there's a problem, maybe you would suggest a source of finance that is applicable and appropriate to that business. See you in the next sesh.